I'm thrilled to be speaking with Ben Rabidoux today, one of Canada's top housing experts and macroeconomic thinkers. Ben is the founder of North Cove Advisors, where he's been helping major investment firms understand the forces of shaping the Canadian housing market since 2013. In 2021, he launched Edge Realty Analytics to bring the same level of insight directly to real estate and mortgage professionals, and now to all of us looking to make sense of this market. Ben has a talent for turning complex economic data into clear, actionable insights that anyone can understand. He's known for making the numbers make sense, whether he's speaking at industry conferences, private events, or in the media. His insights have earned him a trusted voice among financial professionals, policymakers, and everyday Canadians alike. You may have seen Ben in major business outlets like the New York Times, Bloomberg, the Wall Street Journal, the Globe and Mail, CBC, Maclean's, Reuters, the Toronto Star, Barron's, the Financial Times, and many, many more, breaking down the trends that affect your mortgage, your home, and your financial decisions. So, hi, Ben. Thank you so much for taking the time today to join me and speaking about the market and the economic trends that are happening in Canada.
My
Um,
pleasure.
Thank you. Yeah. And then I'd like to ask you a few questions, and these questions are pretty much directed to and about what the general public is thinking of and what the average consumer is has on their mind, if that's okay.
Sure. Yeah. Well, I'm happy to give kind of a high level overview. It's an interesting time to be kind of an economics observer in this country because we have this strange situation where the economic data itself is not terrible by any means. In fact, if anything, it's been surprisingly strong in the last few months. Um, but the confidence numbers are just so unbelievably soft. So we have this strange dynamic where it appears that Canadians feel maybe a bit more pessimistic than the data would warrant. And of course, for folks in the real estate space, this matters a lot because if consumers don't have confidence, it's really difficult for them to make the largest purchase of their life, notwithstanding other considerations like affordability. Even if they have the money and they have the ability to afford the payments, if you don't have the confidence, it's just the market kind of just freezes up, and that's sort of where we are right now.
So I guess my question to you when we talk about consumer confidence and affordability, when the average consumer is listening right now, I'm probably thinking this is what they're thinking in their head. What triggers consumer confidence? Like, is it the news? Because I remember back in the day, I'm 51 years old, 20 years ago, there was no social media, no Facebook, no Instagram. So you literally had to just turn on your TV and listen to CNN or something, right? What is triggering the consumer? How is the confidence being built up today?
Yeah, it's a great question. And you do wonder how much social media and kind of that like engagement farming is affecting people. Because one of the things that we're discovering is a lot of the algorithms in social media are designed to trigger you, right? Because they know if they can trigger you, they've got your engagement and you'll spend more time on the platform, et cetera. And it's a great question as to how much that might be filtering through to this, what I would suggest is like an unnecessarily bearish level of sentiment. Now, look, on one hand, you sort of understand where consumers are coming from, right? We've just come through a period of time where the interest rate shock was the most profound that we've seen in 30 years in the country. And I know there'll be folks listening who are in their 60s and are like, hey man, my first mortgage was 17% or whatever. But when setting that aside, going from 2% mortgage rates up to a high of 7% mortgage rates,
Yes.
given the sort of debt burdens that we have, that was a shock, right? So we're just coming off of that. And just as we're starting to recover and sentiment starting to return, then you get this thing where it's like, 51st state talk, 50, out of the US and Canada become all this stuff coming from President Trump and then the trade tensions and everything else. And so you do wonder if how much all of that plays into filtering through to Canadian confidence for sure.
Confidence. Okay. So I have a few questions here, and One that I'd love to ask you is, should I get this question asked a lot, probably maybe two, three times, maybe even five times a week. Should I buy now or wait for the market to crash? Okay. I'd love to hear your thoughts on this. And like from the consumer standpoint, like this is what they're thinking right now when they're um, thinking about buying a home or selling and buying a home. So, what is your perspective on that?
Yeah, well, look, I want to be really careful. I'm not here to give any specific advice to any individual listener. So obviously, all everything I'm going to say is caveated by the reality that I don't know anybody's financial situation. Neither of us do. So this is going out to the broader public for consumption.
General.
So
Hmm.
with that as sort of a caveat, um, I think we can kind of have some high level perspectives on this. So the first thing that I would point out is, in one sense, prices have already crashed, so to speak. I think that some people have maybe maybe don't appreciate the magnitude of the house price correction that we're in right now. If we look at house prices, how much they've changed from their peak, are already in the middle of the worst housing price decline that we've seen nationally in 50 years. So, from that perspective, and you can make the argument that prices have already crashed. So, like, I don't know what more people necessarily are waiting for. Now, I want to be really clear when we say that a lot of those declines at the national level are really concentrated in some of the big metros in Southern Ontario and in BC. If you're listening to this podcast in Saskatchewan, your
Yeah.
prices are still at all-time highs. If you're listening to it in Quebec, they're still at all-time highs. But if you're listening to it in Southern Ontario, there's a good chance that the metro that you're in is already down 30% from the peak. It has crashed. So, from that perspective, like, I just don't know how much more downside there is, and I guess the bigger point that I would make is, if it's the sort of, like, just some as just general high level advice. If it's a home that you're going to live in, that is a home for yourself, for your family, that you want to stay in for a number of years, probably as good a time as any to go out there and look for something that fits the bill, because you do have the opportunity today to negotiate, to get all the financing conditions, the home inspections. That was not a situation in a lot of metros a couple of years ago. So it's a very different market. So from that perspective, if you can afford the payments, if you're going to be in the home for a while, I think it's probably not a bad time to start kicking some tires. Could there be a bit more downward price pressure? Like, maybe, but I don't know. I don't think you're going to be here a year or two from now and prices are down another 10%, 20%. I don't think that's likely. But again, this is not financial
Yeah,
advice.
you're right.
Speak to a mortgage professional like Rasha, speak to a good real estate professional, and get that sort of individual advice.
Yeah. Yeah, correct. Thank you for that. My advice to clients is that if you're ready now and you're financially ready in terms of down payment and income, credit, um, and monthly payments, so like budgeting and make sure that the payments are going to be affordable. You're renting right now anyway. That is if you don't, like, let's say, live with parents or you're not paying anything. But if you're paying that, if you're making that payment of $2,500 a month in rent plus utilities here in Windsor, let's say on average, and you can buy a house with 5, 10, 20% down and have an equivalent of $2,500 a month or a little bit more, at least you own the house, you're building equity, and when price values do increase in the future, you've built equity and your monthly payments have not gone out the window. Okay. And that's how when I speak to my clients, that's what I discuss. Because you never know. It's like the stock market. You wait for it to go up or down. Who knows? Like if we all knew, we'd be millionaires now, right? So
Mm-hmm. Mm-hmm.
So
Yep.
the next question would be, what risks do you see on the horizon, economical or policy-wise, that could significantly impact Ontario's housing market in 2026 or 2027, such as interest rates, immigration, housing supply, or rental market changes? And is there anything you see that the average person might not be aware of? Some insight or a trend that could help buyers or sellers, or mortgage professionals think ahead and make smarter decisions. And the reason why I ask you that is because you and I both know how like government policies come out and rules that come out and they go in place within like months and the consumer's like, "Oh, I thought I could do 30-year amortization. Now it's gone," right? So, things like that. What do you think might happen in the coming years that we should be aware of and give the consumer the right information so they can plan ahead, if that makes sense?
Yeah, yeah. Well, I mean, it's a big question. There's a lot of angles we could go. I mean, I don't think so. From a risk perspective, I think they're pretty well known. I mean, you're always mindful of the fact that oftentimes the worst shocks to the economy are the ones that nobody sees coming, that come from some, esoteric shock at the other side of the world that hits our shores. And so to that extent, like you never know what it could be, but in terms of what we have some line of sight on, as we look to 2026, I think one of the concerns is we are entering a year where the CUSMA agreement, so the new NAFTA agreement, is going to be revisited. There's some signals out of the White House that perhaps they're going to withdraw from that. Like there's still, my point there was just so there's some trade tensions that are lingering. There's some potential there that could still weigh on economic growth and employment. So that's one thing to watch. But we also just have to be mindful that risk goes two ways, right? Like there's a risk that the market goes down and the economy weakens, but there's also a risk that things end up being better than we expect and we're not positioned for it, right? So there's all you got to be mindful. There's two sides to that, and I think right now there's a lot of emphasis on what could go wrong, and that's warranted. It is a lot of uncertainty in the world right now. But I do think we also have to have an eye towards well, how could things go better than people expect? And I think, as we look towards like high level trends, one of the things that I've been flagging for my Edge Analytics subscribers and my institutional clients is that if we look at construction activity for single family as an example, it is alarmingly low. So the
Mhm.
stat that I've been showing people is if we look at permitting activity for single family homes in Ontario, and remember, before the builder can start to build a single family home, they have to get a permit from the municipality. So permitting activity is a very good indicator of future supply. And right now, permitting activity is as low as it's been since the 1980s. So that tells us that there's going to be a lot less single family supply, probably starting in kind of mid 2026. And I actually have a view that the market for single family in some of the big Ontario metros will actually start to tighten in 2026. I think sales are going to get a little better from here. I don't think we're going back to 2021 crazy levels, but I do think we're going to see a gradual improvement in sales, primarily driven by a return of first-time buyers.
Okay.
And I think that's also going to coincide with a bit of a tightening in supply. So, you can paint a picture for how certain market segments have the potential to improve, and I don't think a lot of people are talking about that. Now, having said that, so that gets back to this view that if you're a first-time buyer, there's probably some interesting opportunities. Now, if you're an investor, I think the risks are tilted a little bit to the other side because I am of the view that there is an underappreciated amount of rental supply coming. We can see this in the construction data. And unfortunately, the key source of rental demand in the last few years has been international students and temporary workers. And those are cohorts that the federal government is very committed to tightening. And in fact, they're anticipating a significant decline in the numbers of international students, temporary workers over the next couple of years. So if you kind of overlay like a pretty big increase in new supply based on what's under construction with pretty soft rental demand, I would argue that we're probably going to see a couple of years where rents maybe trend flat to down and vacancies probably trend up. So there is some risk if you're in that investment space, but otherwise, I think for first time buyers, it's probably an interesting time to start engaging in the market.
Do you see that, because we like to talk in Canada in general, do you see certain spots or pockets in Canada that will do better for investors than others, like Edmonton versus Ontario or Quebec or
Yeah, so there's a lot of moving parts here. I mean, what I would say is I would be very leery of any big population center that's tied to a college that has levered a lot of the growth off of international students.
Hmm.
So, for example, if you are in that kind of Kitchener-Waterloo area and you have benefited from the tremendous inflow of international students to Conestoga, as an example,
Yeah.
that game is over. Like that's not coming back for years.
Oh,
If
wow.
you're in a university town, it's going to be different because they never really levered off of that growth to the same extent. So that growth will still be quite constant.
Mhm.
But other than that, like the big Ontario metros aren't flashing red the same way to me that say some of the metros in, for example, British Columbia, Atlantic Canada, and even parts of Alberta are starting to show. Like I see a lot of new rental supply coming in those areas, a lot
Yeah.
of rental supply coming.
Here's a crystal ball question. We all love that crystal ball, eh? I'd pay $1 million for it. How low do you think interest rates could go over the next year or two? Both fixed rates and the Bank of Canada rate, which influences the variable rate mortgages and adjustable rate and HELOCs, which are home equity lines of credit. What factors will drive these movements, and how should the consumer use the information to plan ahead?
Yeah, great. So again, lots there. So look, let's just start with a baseline of what the market is telling us. So if we look at kind of market expectations, believe it or not, they're saying that this is the low, that the Bank of
Oh,
Canada is done cutting, and they're quite forceful in that view. And in fact, if we look at the odds as we get towards the end of 2026, as it's currently priced today, there are higher odds of a rate hike towards the end of 26 than another rate cut. Now, that's what the market is telling us. Now, again, the market is regularly wrong. And when I say the markets, this is how certain interest rate instruments are priced. We can sort of derive off that pricing how they think the Bank of Canada is going to go, if that makes sense. So that's what they're telling us. Now, I still disagree with that. I personally believe that there is still quite a bit of uncertainty in the economy. I think some of the jobs numbers recently that have sort of blown expectations out of the water. There's some questions as to the reliability of that data in my mind. For example, like I just don't believe we've created 160,000 jobs in the last 3 months, and
mhm.
it just does not compute with everything we're seeing in terms of job announcements from big companies. And it also doesn't compute, this is really important, it doesn't compute with some of the other indicators of the labor market that Stats Canada tracks. So, for example, and this just not to get too far into the economic weeds here, but for your
Yeah.
listeners, they may appreciate this. So, there's actually two main jobs reports in Canada. The
Okay.
one gets all of the attention and all the headlines, and that's what we call the labor force survey. It comes out generally the first Friday of the new month, and it kind
Okay.
of tracks the most recent month. So very timely data. So we just got the November data last week. So very, very timely. Um, but then quietly, about a month later, we get a separate data report that is called the Survey of Employment Payrolls and Hours, right, which is a mouthful. But to sort of make the distinction, the labor force survey, which is the really timely one, that's what's called a household survey. We pick up the phone, we call a bunch of people. Hey, do you still have a job? Yes, no. And when you call people, a lot of times people just don't want to talk to you. They just like, hey man, like I'm having dinner, don't call me back. And they just like, see, you don't always get good quality data. Okay.
Okay.
Now contrast that with the payrolls, which is the one that no one really pays attention to. And that payroll job report draws from actual payroll remittance from businesses. So it's very good quality data. Now,
Yes.
here's why I flag this. This is
Yeah.
very important. The labor force survey, which
Hmm.
is the more timely data that everyone pays attention to, according to that, the jobs are great, right? The economy is doing great, lots of jobs being created. But the payroll data, which uses actual data from businesses, is showing the exact opposite, that we are losing jobs in the private sector, and that we are actually seeing the lowest level of job creation since the COVID downturn and since the financial crisis. So you have literally two important jobs data series from Stats Canada telling us polar opposites. And so the rates market is really taking the word of the one and
Yep.
ignoring the bad news. And I think that's a mistake. To me, the payroll number just feels more accurate when I talk to businesses, when I talk to people. It does not feel like this is a booming economy. It just doesn't. And so if it turns out that the payroll number is in fact the correct number,
Yep.
then we will see more job cuts coming, or sorry, more rate cuts coming, likely kind of in the back half of 2026. So that's That's a very detailed explanation for kind of the macro data.
No, I
Now,
love
like, put a
it.
bow on it. Yeah, to put a bow on it for you. So right now, the Bank of Canada is at 2.25%.
Yes.
A really good rule of thumb for your listeners is if you take the Bank of Canada rate and you add roughly 1.75% to it, you
Yep.
get like a really good
Like,
discounted mortgage rate. So you're kind of in the 4% range, give or take right now,
correct.
right?
Mhm.
So I think we could see two more rate cuts from the Bank of Canada, which would put the overnight rate down to 1.75. So if you add that another 1.75 to that, you get a rate in that kind of 3.5% range. Um, but again, there's a risk still now that was not there 2, 3 months ago, which is that we could actually see rate hikes towards the end of next year. So the way that I would think about it is rather than trying to get cute as a consumer and time the market perfectly, my advice would be if you can get a mortgage that starts with a three, right? Or even in kind of the really low four, man, I'd be pretty inclined to lock in because for the first time, you've got a chance that we could see hikes. It's not outside the realm of possibility that towards the end of next year, we're back into a hiking cycle. So I would just say that that's a really simple barometer for how to think about things. I think it's likely that we get cuts, but it's no longer a guarantee just based on kind of how the economic data has
Mhm.
unfolded.
Interesting. So now it kind of gets my mind going, like how will the government, how will we understand or know, or the discrepancy between the two reports that come out? The one that is viewed and gets a lot of attention, but the second one that doesn't. Why is the government not looking at both reports and making sure, what's the discrepancy?
Yeah, no, I get your question. So the short answer to boil it down, we've actually never seen the two jobs reports give this far of a gap
A
in their
gap.
results.
Okay.
Yeah, it's never happened. They almost always track each other pretty closely. Like they'll sort of veer off each other, but they trend in the same direction over time. And right now, you've got the biggest difference between those two data series on record. Now, I'll just say historically, the
Okay.
payroll number, which is the number that's saying right now that things are not good, that number has normally been the better indicator over time. So
Okay.
I think what's likely is
Okay.
that as we go into 2026, we will see that headline, like the labor force survey, the jobs number that everyone pays attention to. I think it'll start getting softer and softer, deteriorating, and it will realign with the payroll data over
Okay.
time because they
Okay.
do tend to they do tend to converge over time. And right now they're the widest discrepancy on record. So
Okay.
we'll see. Maybe it could end up being that the payrolls somehow are wrong, and we're going to see massive growth there, and those two numbers realign by the payrolls getting better. But I just don't think that's likely. We'll
Okay.
see.
Okay. We'll see. Um, for consumers feeling priced out of the market, okay, are there creative strategies you've seen work, such as alternative neighborhoods, smaller communities, home types, timing approaches, that could help a consumer get into a home? And from a mortgage professional perspective, I'll get the call where I'll have, a family household of, let's say, 120,000 or $100,000 of income. That will give the consumer a 400 or 450 $100,000 mortgage, right? And if they have any outside debt, like a car payment or even a child support payment, a lot of people don't think of that payment going as an obligation on the application. That will affect how much you qualify for. So if you qualified for a $400,000 mortgage, now you might qualify for a $300,000 mortgage. So if you only have $50,000 down and you're purchasing a home here in Windsor, Ontario, and the average price is, let's say, 500,000, 450, around there. That's where consumers are getting priced out of the market. Now, the government recently this year, for first-time home buyers, increased the amortization from 25 year to 30 years on an insured mortgage, which was a great thing that they did. And a few things that they did that was great. What do you think about the stress test? Like, every time I think about
Yeah.
it, I'm like, the reason why the stress came about is because the government wanted to make sure add 2% to the discounted rate to make sure that when these mortgages come up for renewal, that clients will qualify for the mortgages that are coming up for renewal, right? Um,
Yep.
well, interest rates are higher now, right?
Yeah.
Why do we have the stress test? And consumers are, it's affecting the first time home buyers, it's affecting the overall consumer.
Yeah. Well, so first of all, to the first part of the question, as it relates to people sort of on the affordability piece and what sort of strategies people can use, I think your answer was super articulate and highlights the importance of speaking to a knowledgeable mortgage professional. So that question is probably beyond the scope for a simple economist like me. You're into kind of the realm of the personal finance space, and there I would refer your listeners to knowledgeable professionals like yourself. Um, Now, as it relates to the stress test, I think you've got a great point. Like, first of all, um, I know the industry was not a fan of the stress test when it was first rolled out back in 2018. I think with a bit of hindsight now, especially having gone through a rate hiking cycle like we have, I think we can all acknowledge that, holy cow, like that stress test actually helped a lot of people at the peak avoid what could have been a really ruinous outcome. But you absolutely make a good point. Do we still need a stress test with interest rates back in line with long-term averages? And I think that's a very open discussion. So what I can tell you is we know from the public disclosures that OSFI, which is the mortgage regulator or the bank regulator in the country, the one that implemented the stress test, they have been looking at alternatives to the stress test. And I do think that the stress test will be removed, at least in part, in early 2026. And
Oh,
so there's one of two things that we could see. So, and again, we're getting a little bit in the weeds for your average listener, but just to explain it. Um, so the stress test right now, the way it's structured is if it lets you, to use a really simple explanation, let's say your mortgage rate is 4%. The banks are going to say, well, we're going to tack another 2% onto that and make sure you can afford those payments. I mean, that's a really simple way to think about it. It's a little more nuanced, as you know, but what OSFI is looking at instead is a debt to income limit of 450%, so 4.5 times, that's applied at the portfolio level at the banks. So, in other words, they would say that the banks in aggregate, you can't originate more than X percentage of loans above 4.5 times income in any one quarter. And so rather than a stress test, you then sort of remove the onus from the mortgage professionals to do that stress test on every individual file. And
hmm.
you give the banks the freedom to sort of choose which loans they want to be as sort of a higher leverage. Um, that I believe we'll see something like that in 2026. Either that or just a walk back of the stress test from 2% to maybe 1%. So I think one of those two things is very likely. And the net effect is this. Um, it will help the market when, so right now, for example, it'll free up a bit of affordability. Where it will actually act as a bit of a drag is when if we ever get back to a situation where interest rates are at zero, then it will actually cap the upside to the market, right? Because now all of a sudden, if interest rates were zero, you could borrow more. You'd have more borrowers that could borrow in excess of 4.5 times their income, but it would cap how many actually could at the bank level. And so, it wouldn't matter now, but it would sort of be a dampener if we ever got back to a zero rates environment, which frankly is what you want. You want to prevent the buildup of leverage in those low interest rate environments. So that's a very long-winded way of saying that in early 26, I do think you'll see a change to the stress test, and it'll probably be for the better.
Okay. Okay. Well, thanks for answering that question. Um, and this is a question that's been on my mind, and I'd love to get your take on it. The media has been talking a lot about home prices dropping in the GTA and in Vancouver more than anywhere else in the country. What's driving this movement, and what should homeowners and buyers in these markets be aware of? I know there's a lot of chatter online, and we could probably Google some of these answers, but I really want to hear it from your professional perspective.
Sure. Well, I mean, I think there's sort of 4 or 5 factors at play. So if we sort of walk through them one at a time, the first and most obvious is that those are the areas that saw the strongest run up in prices coming out of COVID.
Mhm.
So to some extent, you're seeing a bit of an unwind of some of those crazy moves because you got to remember, like a lot of the Southern Ontario metros, they saw 40, 50, 60, 70% price appreciation over 2 years coming out of
Correct.
COVID.
Yeah.
Really remarkable. So we're sort of giving back some of that froth. That's the first thing. The second thing I would point out is um, we don't have like tremendous data on the prevalence of investors, but the data series that we have shows that those big Ontario metros and the BC, southern BC metros saw a lot of investor activity coming out of COVID that in a lot of ways sort of created excess demand, bid
Mm.
up prices, and now we're finding that a lot of that investor demand has moved to the sidelines. So those are the areas that have seen the sharpest pullback in demand because of that investor cohort. And so now, and then the third point that I would make is related to that. Um, those are also the areas that attracted a disproportionate amount of new immigrants. And we had a tremendous wave of immigration post COVID, that kind of 2021 to 2024 period. A lot of that cohort landed in Southern Ontario and BC. Now that the government's really trying to clamp that down, we're seeing the growth has really slowed in those two provinces. So population growth is effectively zero in those two provinces right now. And so that's factored in as well. And then the final piece is just that those are the parts of the country that do struggle with the most challenging affordability dynamics. And so it would stand to reason that in an era where rates are still a little higher than they were pre-COVID, that those would be the parts of the country that would sort of struggle a little more.
And what are the most common mistakes buyers make in today's market? How can they avoid them? I mean, I usually like going, like when I talk to a customer, and they're looking at buying a home or selling a home and pulling out equity. There's a lot of things that can happen in this transaction that can, at the end of the day, and you come to the closing, and you have a shortfall because of this or that. What are you seeing the common mistakes that a consumer can make today that can hurt them financially when it comes to buying a home or being in this market?
Yeah, so I think again, you're making a great commercial for the need to work with a professional because there are a lot of pitfalls right now. And me myself being a simple macro observer, I see things from the 10,000 foot level. You see things day to day of what's actually happening. So I think that's a great plug for working with someone like yourself and the real estate professionals that you would work with. Um, but I think from a high level, some of the mistakes that we're seeing right now is just excessive leverage, particularly in the consumer side. I think a lot of people underestimate how much that car payment, for example, taking on $1,000 a month car payment at the time is exciting, and you get a cool car for a while, but then all of a sudden you go to get a mortgage and you realize, holy cow, that really limits what you can qualify for. So I mean, you see things like that. You hear the stories co-signing for other people and how much that can back to bite you. So you're into the realm of kind of personal finance related type questions. And there again, I would just refer people, to the professionals, especially before making a firm offer. Make sure they get in and talk to folks like you to make sure that all their ducks are in a row, as it were.
Well, thank you. Um, I'll end by asking if there's anything you'd like to add. Is there anything that you think that I might have not asked you that maybe we should be bringing up to the forefront to the consumer that is important in today's market?
Well, I guess just from a high level, I was pretty I guess bearish. For anybody that's not familiar with that term, kind of means negative. So for a couple of years, more than a couple of years leading up to the peak, I was pretty cautious on the prospects for house prices, and things kind of ran for a while and have kind of pulled back. And now I just find that oftentimes I'm on the other side of that. Like I feel like for years there was too much optimism, too much maybe unbridled speculation in the market, and I was cautious when I saw that. And now I feel like there's almost too much pessimism. I think there's so much baked in. There's the reality that we've had for the last couple of years of a very soft market, a downward trajectory in prices. Consumers are funny. We just, as a species, we're all about pattern recognition and taking the most recent pattern and extrapolating it into the indefinite future. And
Mhm.
people were doing that in 2021 and 2022, thinking that prices were going to go up forever at a crazy pace, and consequently making some pretty bad decisions. And I feel like today, if anything, it may be the opposite, where people are extrapolating a negative situation into the indefinite future. And it's keeping them from making some decisions that would probably benefit them in the long term. Like, for example, if you want to buy into this market, there's some deals to be had out there, right? There's some and you can be active in this market. You can be making good offers with all the conditions in place. So I guess I would just, from a high level, just sort of caution people not to get sucked into this incredibly bearish narrative. There are risks out there in the economy. We understand that. There are always risks. There's always a reason to be pessimistic if you look for one. And I think right now is the time that people maybe need to be considering the other side, which is what are the reasons that things might get better, right? And so I'm actually cautiously optimistic for where things are going to go in 26. Especially if we can get a trade deal and a bit of stability on this side, on this front. I think we could actually see a decent year for housing.
No, I agree with you on that. And like from my perspective, when I talk to clients, I always say, buying a home or investing in a property is a big financial decision that you're going to make in your life. It's one of your biggest, probably, unless you're going to buy a plaza in the future or something like that. So, making sure your numbers, doing the math, all these numbers matter. If you miss out on one little item, it can affect you financially in the future, and making sure that you you calculate all your budgeting and your math, and like where's the money coming from, and is it coming from a sale of your home. It really matters. And having a budgeting sheet is so important, and looking at it every month and studying it and visualizing it. Believe it. Yeah. I'd also love to hear about, because I love, love, love reading books. And I've even read some books twice and three times because I like to absorb them the second and third time I've read them. I'd love to hear about a book that you've recently read. And it doesn't have to be like an economic book or market trends or anything like that. And how it's related to your life, and how maybe you're using it in your everyday like thoughts and moving forward with your life.
Sure. Well, I mean, I'm not a big fiction guy. I'm pretty boring. I do read a lot of finance and economics type books. So I will go in that direction. I have to put a plug in for my friend Dave Chilton, who actually lives down your way. Dave Chilton's the author of The Wealthy Barber, which was one of the all-time top-selling personal finance books. He was also a dragon on CBC Dragon's Den. I was on his podcast not too long ago. Just a remarkably good communicator, a great author, and he's back with his book, The Wealthy Barber Returns, which is an updated version of his tremendously popular original book. And I think it's, having read it, it's just such a it's such an easy read for Canadians that does such a good job of breaking down so many of those kind of common sense investing, just wisdom, and in a way that's particularly practical for Canadians. So I would say for anybody listening, if you've got kids that are starting out, that are just beginning that process, great book for them. Anyone that wants that sort of accessible personal finance book that's easy to read, fun to read. He's a very funny guy, very good writer. So I would absolutely recommend The Wealthy Barber Returns for anybody that's listening.
Okay, wonderful. I actually read that book twice, and I've also
The
purchased
original or the new one?
the original. I do want
Oh
to
yeah,
read the
yeah.
new one. Um,
It's good. It's totally different.
oh yeah, I read The Wealthy
Yeah.
Barber the first time, probably in I want to say maybe in my 30s. I think that's how old the book is, like 20 something years
Oh yeah.
old.
Oh yeah. No,
Um,
older than that, I think.
and then I read it again. And then I actually bought a few books, maybe like 30 of them, and gave them to my clients at one point. And
Yeah.
I put my business card on it. And then my son, when he was in his, like, I think he was 17 or 18, I bought it for him. I think it's an excellent book to read. And I wish I had read it early, in like when I was in my early 20s. So yeah, I do agree with you on that.
He's a phenomenal communicator, Dave Chilton. And this new book, the updated one, I would strongly recommend, if people listening, you can get the original Wealthy Barber, but the Wealthy Barber Returns covers a lot of the new instruments in Canada, the tax-free savings account,
Oh,
the
okay.
first-time home.
Wow.
So it's got all of that embedded as well that it covers. So it's actually perfect for people who are trying to sort of get a handle on this whole thing, personal finance in 25, 26, right? It's a great read for those folks.
Thank you so much for speaking with me today. It's a pleasure. Hopefully we can do this again. Lots of fun. And when you do come down to Windsor, I think you're coming, right? Down
Mhm.
sometime soon.
Yep.
So hopefully we'll do something together, and maybe we'll invite some people and get them to meet you in person.
Yeah, that'd be great. No, I appreciate it. Thanks, Rafi. Good luck with this.
Awesome. Thank you so much,
All
Ben.
right.
All right.
Yeah.
Talk soon. Thank you.
Take care.
Bye.
Bye
You
bye.
too. Bye.